The marketing promise is simple. Click one button to copy elite traders and generate wealth without the work. But the reality is far more clinical. Chasing high ROI figures without understanding the underlying strategy almost always leads to a rapid liquidation of your account. Social trading does not remove your exposure to the market. It simply forces you to trade market risk, the volatility of price, for manager risk, which is the possibility that the human you are following makes a catastrophic error. This process is not for gamblers seeking a lottery ticket. It is for intermediate traders moving from solo technical analysis to the role of a portfolio manager. Maintaining consistent profitability requires a specific trade-off. You must exchange the hours spent staring at individual charts for the rigorous upfront work of human due diligence. The social trading ecosystem is divided into 3 distinct models. Confusing them is the most common reason new participants lose control of their capital. Copy trading involves the real-time proportional automation of a human's live trades. If they buy a specific volume, your account replicates that position relative to your balance, though you retain the authority to close individual trades manually. Mirror trading is different. It is the execution of a predefined algorithmic strategy, offering significantly less control over individual entry points or position management. Signal services are the manual alternative. You receive analytical alerts detailing entries and stop losses, but the final execution rests with you, and your capital is never directly linked to the provider's account. For the strategic optimizer, copy trading provides a balance of automated execution and the essential ability to veto high-risk positions. Most platforms encourage a dangerous habit, sorting and selecting master traders based purely on a massive short-term return on investment. A 300% return in 3 months is a red flag indicating reckless risk, creating a performance curve mathematically prone to the sudden crash you see here. To protect your balance, ignore ROI and evaluate maximum drawdown, the largest peak-to-trough drop revealing near total failure. Filter your managers using strict defensive parameters. Target those with a maximum drawdown under 25% and a consistent positive risk-to-reward ratio. Choosing sustainable growth means intentionally missing out on short-term hot streaks. These streaks are almost always followed by a dramatic and expensive correction. After vetting the manager, you must secure your own capital allocation and technical setup. Never risk more than 10% of your total capital on a single master trader. Spacing your exposure across 2 to 4 uncorrelated strategies creates a buffer against individual manager errors. Avoid the trap of copying 20 or more traders. This leads to high spread fees and diversification, where winning trades are canceled out by losers, making it impossible to monitor your total risk. Leverage mismatch is a silent account killer. If your manager trades with 100-to-1 leverage, but your account is set to 500-to-1, a minor dip that they easily survive will end up cracking your account through a margin call. You must also account for slippage and latency. In fast-moving markets, a delay of even a few seconds can change the execution price, turning a manager's profitable trade into a net loss for you. Even the most skilled master trader cannot protect you if your own platform infrastructure and leverage limits are not meticulously fortified. Social trading provides a live, active learning environment for the intermediate trader. You can use these tools to reverse engineer a professional's position in real time. By questioning their entry triggers and stop-loss placement, you can begin to see the underlying logic used by institutional-level participants. The analytical tools at FXNX are led by Kenji Watanabe, whose approach to yen crosses and technical patterns was developed through a master's at the University of Tokyo and years as a researcher for the Bank of Japan. Decoding the moves of analysts with this pedigree provides a practical education in high-level economic methodology. Treating copied trades as a paid masterclass allows you to extract permanent knowledge from the market, using their expertise to improve your solo trading skills. This chart displays the path to becoming a copier-turned-strategist. If you are looking to dump your account into a high ROI strategy and check out, the market will eventually take your funds. But if you commit to analyzing trade durations, asset classes, and setting hard master stop losses, you can achieve the consistency of the top right quadrant. Demand 3 non-negotiables from any platform: transparent performance histories, negative balance protection, and ultra-low latency. Negative balance protection ensures that even in extreme volatility, your account balance cannot drop below 0. Advanced platforms like FXNX provide the analytics you need to verify the data,
but the responsibility to deploy that information and protect your capital is yours alone.